Good morning, Brenden Rendo with the Homes in Orlando team, joined as always by Dionne of Appli Home Loans. And we're going to hop right into it because we just got smacked with the jobless numbers.
It's always interesting because I feel like we hearing all this news about tech layoffs and this and that and all, and then you expect maybe jobless numbers are going to go up. And what do?
Exact opposite.
Exact opposite. They go down. And I'm curious what's going to happen when revised numbers come out at some point. But you know what? The problem is the damage has already been done.
Yep. I mean, this morning market got crushed. Expectations: 187,000 new jobs, 517,000 new jobs in January.
What?
517,000.
Where? In what field?
I have no idea. I got no idea. I mean, I haven't seen that many kids come out of their parents' basement. Just haven't.
And last I heard, it was going back to the office. It's not staying remote.
Yeah. And you're looking at it going, it just doesn't, the numbers don't calculate.
It doesn't. And that's the hard part. That's the confusing part for me is like in mainstream media, you see everything else. So you don't know what you're really getting. And it's like, but what I've seen pulse on the ground from what I'm hearing around and people I'm talking to and everything else is that the higher end, right? These tech companies, those jobs that are actually like really good, those are what are being lost right now. So are these ones being created, those store clerks and fast food restaurant and stuff like that? Are they actual, are they jobs that actually like support and build the economy in a grander scale? Or do we have a whole bunch of high schoolers that are now getting thrown into this new jobs report?
Exactly. Or is it because of inflation, people taking on second jobs?
It could be that.
Because inflation is just crushing people. Our whole discussion today was going to be affordability. And, with the jobs number coming out, what happened? T-bill just shot through the roof. Literally in the past 15 minutes, the Treasury yield shot way over 4. It hasn't been over 4 in a couple days, kind of peaked and settled back under, but we're above 4 and we're staying there.
Yeah.
And if you're the Fed has been looking and using the employment numbers to kind of figure out where they're going to their target's going to be.
And that's the key, right? Like they're saying employment's so strong and unemployment's so low that we got to keep
crushing the economy. We got to keep raising rates.
And it's just a weird cycle right now because it's like, I don't think it's like we're not as strong as what these reports keep saying.
No. Look at the manufacturing number yesterday.
Yeah, manufacturing was down.
Manufacturing number was down. If manufacturing is down, these jobs aren't going into manufacturing.
Yeah.
So where are they going?
Where are they going? And that's the interesting. That's what I would like to know. And here's the thing, manufacturing is down, which usually you see manufacturing numbers go down a little bit. You're going to see what? Small improvement in rates, right? Mm-hmm. What did we see yesterday? Rates got smacked and we got way worse again. Like we saw, so it's like, okay, well, we see that. And then we have today's news, which we know is bad for rates. And it's like, well, how much worse is it going to be for rates if good news was bad for rates? And now bad news for rates, we're going to see a bigger yield. And I keep on hearing all this talk about March 10th, March 14th, we've got these reports. We're going to see this. These are when inflation numbers are going to start yielding positive. And I said, yeah, we may actually see rates drop, but it's because rates got pushed up so high in the weeks prior that the only room for them to go is to go down a little bit.
Down. Yeah. I'm right now. I bet you we get leaks coming out of the Fed, different governors coming out saying 0.75.
And in January, we were talking about 0.25 being the new norm, and maybe not even have to do a whole bunch of adjustments. But
Mm-hmm.
we're going to see that really carry through this year. I think we're going to see a lot more. This might be the wrong word, but turmoil, and how with all the data and everything is just going to be all over the place. And I feel like we're
Mm-hmm.
going to have a few more months of that. I don't know if we're going to stabilize at all, but we're going to see something. And and at some point we're going to get a gut punch.
Yep.
I don't think we're going to have this super easy, super simple. But what does that kind of mean? Like, well, I think it kind of means like with what we're looking at, like, and we'll get into this a little bit more, is those numbers, like buying right now, if you have the ability and the means, like might make more sense than prior. Like we joke that a lot of consumers, when there's a lot of volatility, like to stay on the sideline and kind of go figure it out. But right now, volatility, like if you felt
It's
that way
not
in
your friend.
December, you're getting worse. Like if you're like, market's starting to get better, I'm going to hold off and see what's going to happen. We're a whole percentage point higher.
Yeah. In a couple weeks. I mean,
You know,
when we sit here and we look at this.
look at that February. Look at February.
Look at this. End of January. 5.99. Okay. Here's yesterday, 6.9. That's a point. And you want to see, I just had this up because we like to go through this.
Mm-hmm.
I'm going to break it down to a day. Actually, 5-day works better. Well, holy cow. Look at this. This is where we started this morning.
Can you pop it on the screen for us? I'm not seeing it.
Oh, sorry. It didn't switch. Sorry.
No. Up. That's exactly what's happening with the
Hold on. There it is.
There we go.
There we go.
Yeah.
Look at this morning. We started at 3.99. We're at 4.06. Your rates are going to go explosive this morning.
It's going to be beautiful. You know, it's a thing of beauty when we can look at the technicals and we're like, man, we know, like, hey, once these open, it's going to be way worse. The problem is like those jumps we don't want to see. You just don't want to see them.
No, and you see back here, jump, 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 and they're all jumps to the high end.
Yeah.
So you and I were talking about, it's like, okay, because one of the things we wanted to talk about today with the affordability was we were looking at, okay, last month when they were sitting at 6%, what were we looking at as far as costs?
Yeah.
The principal and interest on a $400,000 house, which is the average and median price of a home in the greater Orlando area, your P&I is sitting at $23.98. Well, we just said 7%. You're jumping about $260 upwards. So that's actually about a 9% increase in the cost of your mortgage. That's a lot.
Yeah.
And we're probably actually going to be talking 7.25% very easily.
Oh yeah.
By the end of the day, if not higher.
Yeah, and that's the thing is, like, even when we see these rates of like 7 and so forth in these average rates, those are like top tier rates. Like that's not what everybody gets. That's like your 500,000 put in 30% down with a 780 credit score, like perfect. And I always joke like this, like when you have those perfect scenarios, investors are willing to go even skinnier on those deals, so they end up getting below where they probably should to get that 7% rate that's showing as that national average or whatnot. Or that, but the reality is for the average consumer, they're already at 7.25. So today's movement may move to 7.5, and that's assuming no points type situation. Like most consumers, almost everybody right now is paying points in some form or fashion, just because you have to. And and that's the hard part is, you look at the movements. And I was looking on the 30-year 5.5 note for UMBS. And I know that you look at we're below, the 30-day, we're past below the 60-day, we're past
Mhm.
we're literally below every moving day average for those reports right now.
Yep.
Which it's tough when you start looking at that.
Yeah.
Um,
And
yeah.
you look at the consumer overall, inflation is kicking the butt out of them. This
Mhm.
is a headline yesterday. And, US credit card debt has jumped 18.5%.
Mhm.
So mortgage rates are going up, payments are going up. You're charging more on your credit cards, so that payment's going up.
Yeah.
So that hurts your DTI. Student loans, which have been deferred for the past almost 2.5, 3 years,
Yep.
people are going to have to start making those payments here.
Yeah, and that's
And
and
within,
that's going to be what I think in June, 2 months after June, if no decision is made.
yep.
And that's the thing where like a lot of people, it's been so long since people have made student loan payments that a lot of them don't even they forgot even what it was like to have that a part of their budget.
Mm-hmm.
And I know that it's, that's one of the most divisive conversations right now. Like a lot of people are like, it's not fair, it's not, it's this and that. Like I will say this, like a lot of people that, and this is just my hot take, a lot of people that say it's not fair, you better believe if you want to take that hard-nosed stance, you may feel a ripple effect in your wallet and in your personal thing, whether it happens or not.
Yep.
Like this is the reality is we're at a point now where if it doesn't go through and people start making payments and we have that hit a massive amount of people and we all of a sudden find ourselves in this, we're going to see an economic ripple effect that may be worse than if we just let it go through.
Yep.
And that's just my hot take. I could be wrong. I'm not saying I'm for it or against it anyway. I think we need to be focusing on how to fix the problem, permanently in the future, like not do a Band-Aid effect, which is what I feel like we're doing. But it is what it is.
So, I mean, and you look at all this and you just got to look at it and like, we have tapped out the consumers in the United States.
Mm-hmm.
We have tapped them out.
Yeah.
One of the biggest reports that no one is mentioning right now is the subprime car loan market. It's crashing. It's worse than the housing crash of 2008. Mm-hmm. The number of repossessions is through the roof.
Well, what did people think was going to happen? It's the easiest thing. Do you really think that everybody should be able to drive an $80,000, $90,000, $100,000 vehicle? Like, it's too easy to qualify for these type of vehicles. Yeah. And it's because of that market. And now they're paying, now we don't have all that free money, so to speak. Mm-hmm. And now reality sets in of crap. I can't continue to afford this.
Yep. So for our clients and for everyone out there, you got to look at it and say, what can we do?
Yeah.
How do we address this? How do we still, because we're going to continue to see it, and we're going to see it here in the numbers in a few minutes, is, how do we change things? Mm-hmm. How do we make it affordable? And I think we do have to start really looking at the buy down programs.
Yeah.
And as you and I have gone through, and we'll attach it to the down below, so you can go back and look at it, is the 2-1 buy down becomes, I think, more and more desirable.
Yep.
Because as you mentioned, is that money set aside, so you're never going to lose that money.
Yep. It's just there. It's in an escrow account. So if rates go down, which is what we hope, right? And we do expect, I do expect them to go down. Barry Abib he's firm on this May Day and whatnot. He's still firm up front of it's going to happen much sooner than later. He might be right. I pray he's right, and because that would be fantastic. But everything kind of feels like maybe end of the year, next year.
Yeah.
But one thing
It's
that we haven't seen is we haven't seen home prices go down, and we're seeing what with inventory.
yeah. Well, that's it. Inventory's stagnant. And when you go back and you look at what had caused the prices to drop, there's our inventory from 2008. We had nearly 3.5, almost 4 million homes on the market. What do we have now? We've got 1 million.
Yeah.
We have 1 million. So you can't, it's the law of economics. If you've got more, it's going to cost less. If you got less, it's going to cost more.
Exactly.
And that's the biggest dilemma we're in. And it goes back to the numbers we had last week, which is 75% of homeowners are sitting at 3% or less on their mortgages.
Yep.
I'm not selling. I'm not going to sell unless I have to sell. Because I'm just looking at this. My wife and I were talking again last night. We'd like to go find like an acre lot out in, towards Eustis, Sorrento, and do a build. And I've got friends who are builders, and I'm just looking at it going, I'm not doing that. I'm not doing that. There's just no way. Economically, it makes absolutely no sense. Especially with what rates are going to do today. So you're looking at this inventory going down, rates going up, and you're just, it's frustrating. And this was an interesting one I saw yesterday from Black Knight, who does a lot of the mortgage reporting. And look at the total originations over the past 2 years. 13.
Not seeing that. Yeah.
I know. I'm sorry. I'm looking at two screens at once. 13 million.
Yeah.
2021, 2020, 13 million. Look at your purchase originations, 4.6. 5 million home purchases, and then we fell off nearly 700,000 in 2022. And the mortgage origination index is down huge in the past 2 weeks since rates started spiking back up.
Oh yeah, yeah.
So it's such a yin and yang difference in that, with the rates being so high and the inventory being so low.
Yep.
Something's got to break. I don't know what it is, but something's going to break. And when it, like you said, it's going to be a gut punch, and it's going to hurt.
Yeah, but definitely, I do look at that, and it seems crazy, right? Purchase origination, like you'd expect those numbers to be a lot stronger for purchase origination in 2020 and 2021.
Yeah,
based on what we felt, right?
Yeah.
Like, the refinance, absolutely. Everybody was refinancing. Like if you didn't refinance in 2020 and 2021, it was only because you couldn't.
Yeah.
Like, that was the time. Yeah. And, you look at it, sales are there. We have this, the numbers are there. We looked at 2008, 9, the inventory, right? To compare to the inventory now, right? Way lower and like thing that, bigger picture, right? Let's think about, population growth during that time.
Yeah.
We've seen almost $30 million or $30 million, 30 million more people. Our population has increased by nearly 30 million people in the US. So from 2008 to now, we got 30 million more people, but we're down a fifth of the inventory. Like that's fine. Like the scales, like everything doesn't really it's saying like, hey, grand spectrum, we may see prices continue to rise.
Yeah. Yeah. And you look at it and you're just sitting there going, here's the one I want to show you. 14 is here's the pricing index that came out on Monday. And you see where we had taken a huge drop in pricing. But what's happened over the past month or so, past
Slow.
quarter. There's prices are still dropping a little bit, but it's nothing like it was earlier in Q3 and Q4.
Mm-hmm.
And why is that? Well, for Orlando, the reason why there's the inventory keeps going down.
Mm-hmm.
And as long as our inventory is this tight, I mean, recently you're starting to see the days on market, drop a hair, but I think we're going to see it drop even further.
Mm-hmm.
I mean, and when you look at it, when we get back and we get into the numbers for the week for Orlando, one thing you're going to notice is that our original list to sales price has gone up nearly 2%. We were at a low of 91 in January. And we were down here, we were 94, 95 final list to sales price. So we've jumped up about 2-3%
Mm-hmm.
over what the bottom was.
Yeah.
Our days on market are still sitting at the 66.
Mm-hmm.
But the sellers aren't discounting as much as they were 5 to 6 weeks ago.
Yeah.
And then our average price, you see, we took that little bit of a dive, but man, we're holding right there at that 400,000.
Yeah.
And with the rates in January coming down, our sales volume is holding at that 400 mark.
Mm-hmm.
And like you and I discussed last week, I think we're going to see this take another dive.
Yeah.
Especially with what happened today. If we don't get some kind of reprieve to pull back a little bit.
Yeah. Yeah. And I don't think there's anything else happening over the next couple of days that would give us any type of reprieve. It's going to be next week if we see any type of reprieve. I kind of expect, and I think some of what we're seeing right now too is a little bit bigger movements because everybody's expecting a reprieve, mid-March, that we're seeing some bigger movements now. It is what it is. So it is.
And here's the thing that's, the gem for sellers is look at the straight arrow down.
Yeah.
I mean, we are actually below 4,000 units in Orlando. I don't think we've been below 4,000 since maybe June or July of last year.
Okay.
Because we had a very steady increase.
Yeah, we had a steady increase, but that's like we're literally starting to build back into it. It's like we're hitting a cycle here. Now the only difference is that cycle was like in super low inventory with super low rates is great.
Yep.
Super low inventory with higher rates, it's going to be interesting.
It's going to be interesting because you've got the buyer who's got to fit within this budget that's extremely tight.
Yeah. And you're still going to have like there are going to be buyers that qualify and there are going to be, but what you're going to see now is you're going to see those 2-1 buy downs play a bigger part. So sellers may have to be like, hey, inventory is low, but I've still got to give some concessions to help the buyers out so that the affordability is there for them. So we may see kind of this little bit of a tug of war where it's, even though everything on paper, it's a seller's market, but we're still seeing concessions going to buyers to help with that affordability piece.
Yeah. That's going to be it is that affordability is just, it literally is the worst it has been in the United States in history right now.
And this is where creative agents and creative lenders are going to have to really work to find solutions and really think. I mean, some things could be super simple. Like, you may look at VA. VA is one of the only is the only loan type in which a seller can give concessions to cover buyer debts being paid off. So you may see concessions go to pay off a vehicle. I don't know. You might see stuff like that to help with affordability to make things work. And I think that's where we're going to see a little bit of that kind of creativity. You're going to see 2-1. I mean, we just closed a 3-2-1 buy down. Like, I never thought in the world that I would see a seller give $20,000+ in credits so that they qualify for it, so they have enough seller credits to do a 3-2-1 buy down. And the buyer's ecstatic about that, but they still bought their rate down permanently beyond that because they were like, I don't want to have to worry about it. 3 years from now, I want to know, like, if it goes back, like, I'm either going to be in a different home or I'll refinance and not worry about it.
Yep. And we're still and because of that affordability, I think that's why we're still seeing days on market holding very strong.
Yeah. And I think because days on markets hold strong, I do this one thing I do love. It gives buyers a chance to breathe and figure out what's right for them.
Yep.
Right? Like, they're not making panic or rush decisions. They have a chance to go, okay, is this really the home for me? Is this what I am? Now it's such a big part of the budget. Like, it's affordability. Like, they have to really, like, you're seeing buyers go, if I don't love it, I don't want to do it.
Yeah. And it's unfortunate, but you've got to educate your clients and basically tell them, hey, don't be afraid to walk away from the deal. Don't be afraid to walk away from the deal. You see sometimes, and because it for buyers, it is so emotional. There's a lot of emotion in buying the house. And that's where we've got to step in sometimes and say, hey, we discussed this. This is what you told me. Go back and rethink it. I understand you love the house. It's got, 90% of what you want, but you told me to make you aware that, hey, this was my budget. Brenden, I really can't go over this. This is going to put me in too tight a position. And that's where, working as a team and having a good relationship, just as with you, is we've got to sit there and we got to look at, how can we be creative? Presenting the 2-1 buy downs, presenting a permanent buy down, finding other ways to, look at it and say, okay, well, you've got this credit card over here. Well, if you can pay off this credit card, maybe we can get a credit to pay for the closing costs over here. And then your burden's down, your DTI's down a little bit. And you got to put it all on the table these days. You really do have to put it all on the table to make it work and make it to where you're comfortable, because you never want to put anyone in a stressful situation. Correct. Where they're worried all the time that, hey, am I going to be able to make my payment? If one thing goes wrong, what is it? 64% of Americans are living paycheck to paycheck right now. Highest in history. So there's a lot of things we got to look at, from being professionals and making sure our clients are going to be comfortable in the decisions that they make. So, thank you, everyone. Appreciate your time today. If you like it, please hit the thumbs up on YouTube, Facebook. Please hit the like. Join us again next week. We'll keep you up to date on everything that's going on in the market. Any questions, feel free to reach out to Joe, reach out to me. Our information is down below as well. Take care. Have a fantastic day.